Governments spend billions fighting drugs. Cartels are hunted. Routes get disrupted. Politicians announce victories. Press conferences celebrate seizures. And yet, if you walk through most major cities, availability barely changes. Street prices barely move. The market shrugs and continues. It looks irrational until you change the question. Treat it as a crime problem, and the story is frustration. Treat it as a market, and suddenly everything snaps into focus. This isn't chaos. It's a system responding to incentives with remarkable precision. Part 1. Framing the drug trade as a market. The illegal drug trade is a global shadow market. Just without the branding, it has producers, wholesalers, logisticians, retailers, and loyal repeat customers. It has product tiers, quality norms, cash flow, credit, and risk pricing. It rewards reliability. It punishes failure, and it operates every single day across every continent. Two economic forces shape everything. First, demand barely moves. For dependent users, this isn't a luxury purchase. It's a physiological anchor. When prices rise, people change dosage, change spending in other areas, but they rarely exit. Second, supply is risk-priced. Every step of the chain embeds legal risk, loss risk, and violence risk into the margin. The higher the danger, the higher the premium. Prohibition shapes the architecture but doesn't erase the incentives. No courts, no insurance, no contracts, so the market invents its own substitutes. Reputation instead of enforcement. Credible threat instead of penalty clauses. Personal credit instead of bank loans. Layered intermediaries instead of transparent logistics. If one node fails, the chain reroutes. If one partner betrays, the network remembers. This isn't admiration. It's analysis, and when you analyze it as a market, the puzzle pieces line up. You see why certain policies never work as intended. You see why prices behave strangely rational. Part 2. Demand side. Why this market is so stable. Demand is the anchor of this entire system. For heavy users, demand doesn't collapse when prices rise. It adjusts, slowly. If the price goes up, many users reduce dose, switch products, move spending from other categories, or simply take on debt. This means revenue for the supply chain remains remarkably stable. There's also a social side that people underestimate. Many buyers know exactly where to go. They know who supplies what, at what time, on what corner. The friction cost is low, the routine familiar. That consistency creates what economists call behavioral lock-in. Once a routine forms, people rarely change it unless forced. Another stabilizer is substitution. If one product gets scarce, users move sideways to alternatives. The chemical route changes, but the demand category stays intact. For legal markets, substitution is a threat. For the drug market, it's a stabilizer. Suppliers know this, so the winning move becomes exceedingly simple. Be reliable. Part 3. Supply side, the basic architecture. The supply chain has layers, each optimized for its role. At the bottom, farmers and small processors. They convert raw crops or chemical precursors into tradable intermediates. Margins are small. The priority is consistency and discretion. Next, local aggregators and brokers. They collect volume, check quality, and coordinate the first transport. They're the glue between small producers and large movers. Then, logisticians. These are the professionals. Their job is not violence, it's logistics. Route design, concealment, modular shipments, contingency planning. They think in probabilities, not movies. Above them, wholesale distribution, warehousing, credit, regional coverage, market discipline. They diversify suppliers, diversify buyers, and manage risk like portfolio managers. Finally, retail. Street-level dealers, micro-distributors, delivery runners, highest margin, highest exposure. They feel shifts in quality first, shifts in policing first, and shifts in demand first. Crucially, information is compartmentalized by design. No one sees the full chain, and that's what makes it so hard to dismantle. Part 4. Why enforcement pressure can increase efficiency. Here's the paradox no politician likes to admit. Enforcement is a form of natural selection. Crackdowns eliminate visible, centralized, or sloppy operators. Who survives? The decentralized, the discreet, the adaptive, the fast. Every major bust teaches the market what not to do. The lesson spreads instantly because the penalty for not learning is existential. When a route is shut down, traffic doesn't stop. It fragments. Shipments become smaller. Transit points hop to new ports, new borders, new carriers. The network becomes more distributed and harder to map. When crops are eradicated, suppliers diversify. New regions, new chemicals, new intermediates. Processes improve. Yields improve. Signatures shrink. When leaders are arrested, organizations flatten. Tasks decentralize. Cell structures form. Pressure, in the long run, doesn't kill the market. It optimizes it. That's the uncomfortable truth. Weak configurations die early. Strong ones adapt and replicate. Part 5. Price stability and risk pricing. Despite chaos upstream, street prices remain shockingly stable. Why? Because risk is already priced in. Margins anticipate. Seizures, spoilage, arrest, theft, adulteration, batch loss. Upstream losses don't translate one into consumer prices. Instead, wholesalers ration inventory, retailers adjust purity, payment terms stretch, margins compress temporarily. Everyone absorbs a little to protect the rhythm of the market. Two more forces pin prices in place. 1. Competition. Most cities have multiple suppliers. If one raises prices too aggressively, others hold the line and gain share. 2. Substitution. Spike the price of one product and people switch. Suppliers know this and avoid big jumps. The result is remarkable. The street-level market looks calmer than the chaos above it. Part 6. Comparing illegal and legal supply chains. Legal supply chains rely on contracts, insurance, courts, compliance, data. The drug trade uses shadow equivalents, reputation, margin and redundancy, credible deterrence, local intelligence, personal credit. And yet the parallels are striking. Both systems specialize, diversify, segment risk, manage portfolios, value reliability. The illegal market is often faster. It doesn't wait for board meetings or quarterly earnings. It pivots overnight. The overhead is lower. The reaction time is shorter. But the weaknesses are obvious too. Violence destroys value. Corruption taxes profits. Scaling increases risk. The system trades legal stability for speed and opacity. Part 7. Regional case studies. Take any supply corridor. In some regions, agriculture dominates. Farmers choose crops that beat legal alternatives by a wide margin. Local processors upgrade the product into higher value, lower bulk forms. Smugglers navigate shifting borders and enforcement zones. Wholesale networks break bulk. Retail distributes across cities. In other regions, synthetics dominate. Clandestine labs, precursor supply chains, production independent of climate. Regulation triggers innovation rather than collapse. Geography changes the script, but not the economic logic. Where governance is weak, agriculture thrives. Where ports and chemicals are abundant, synthetics thrive. Where borders are porous, land routes dominate. Where coasts offer cover, maritime flows grow. Different landscapes, same incentives. Part 8. Winners, losers, and hidden costs. At the farm gate, producers often earn more than legal alternatives, but only capture a tiny fraction of the final value. Intermediaries capture more. Their asset is knowledge. Which checkpoint to avoid today? Which carrier to use this season? Who pays reliably? Who doesn't? Wholesalers capture even more. They finance inventory, enforce discipline, and manage volatility. Retail captures the highest margin per unit, but faces the highest risk. Street-level actors are the most visible, most exposed, and most replaceable. There is also the financial layer, laundering networks that translate cash into assets. They charge high fees for invisibility. The losers are broad. Neighborhoods absorb violence. Hospitals absorb overdoses and long-term health costs. Local economies absorb distortions. Governments absorb the legitimacy loss. And there's a hidden macro cost, talent diverted into logistics and finance that build no taxable capital. Shadow economies erode the trust that real markets rely on. Viewed structurally, this market behaves like a hyper-optimized, decentralized supply chain. Demand is steady. Margins absorb shocks. Enforcement removes the weak. Resilience emerges from redundancy and specialization. This doesn't make the market good. It makes it predictable. Policies that ignore economics fail. Policies that shift incentives bend the curve. Reduce inelastic demand, and the base math changes. Improve legal economic alternatives upstream, and supply pressure eases. Tighten financial controls carefully, and laundering, its most fragile link, feels the strain. The lesson is blunt. When incentives, margins, and demand align, even hunted markets become efficient. If policy fights only symptoms, the system adapts. If policy changes the core incentives, the edges follow. Understanding isn't approval. It's the starting point for results. Stay curious, stay sharp.